Most people believe investing is about finding the perfect stock at the perfect time. They think success comes from secret tips or lucky guesses. This belief leads to confusion and costly mistakes. Many people jump from one idea to another without a clear process. They chase trends and follow the crowd, and in the end, they lose both money and confidence. But the truth is very different. Great investing is not about luck. It is about asking the right questions before making a decision. It is about slowing down when others are rushing. It is about thinking clearly when others are emotional. The best investors in the world do not rely on predictions. They rely on discipline and deep understanding. They do not look for shortcuts. They follow a process that protects them from mistakes. This is where the idea of a checklist becomes powerful. A checklist is simple, but it can change everything. It helps you avoid missing important details. It forces you to think step by step. It keeps your decisions consistent even in uncertain times. In many fields like aviation and medicine, checklists save lives. Pilots do not rely on memory when flying an aircraft. Doctors do not rely on guesswork during critical procedures. They follow structured steps to reduce errors. Investing is no different. Every investment decision carries risk. And most mistakes happen not because of lack of intelligence, but because of lack of discipline and process. You may know what to do, but in the moment of decision, emotions take over. Fear and greed start to control your thinking. And suddenly, logic disappears. A checklist protects you from this. It acts like a guide when your mind is under pressure. It reminds you what truly matters. It helps you stay focused on facts instead of emotions. This book is built around that idea. It is not about giving you stock tips. It is not about predicting the market. It is about teaching you how to think like a careful investor. Each chapter will walk you through a different part of the investment process. You will learn how to understand a business deeply. You will learn how to evaluate management. You will learn how to judge financial strength and growth. But before all of that, there is one important question. Where do investment ideas come from? This is where most people go wrong. They start with random tips. They listen to others without doing their own thinking. They invest in businesses they do not understand, and because the foundation is weak, everything else falls apart. A strong investment always begins with a strong idea. An idea that is based on observation and understanding. An idea that you can explain clearly. An idea that makes sense even before you look at numbers. This is why the journey begins with generating investment ideas. Before you analyze a business, you must find it. Before you study numbers, you must understand what you are looking at. Before you invest money, you must build conviction. Chapter 1 will show you how to do this. It will teach you where to look for ideas. It will help you develop a curious mindset. It will show you how simple observations can lead to powerful opportunities. You will learn that great ideas are often hiding in plain sight. In the products you use every day, in the services people depend on, in the trends you see around you. But finding ideas is only the beginning. The real work starts after that. Still, without a good starting point, even the best analysis cannot help you. So as you move into the next chapter, remember this. Investing is not about knowing everything. It is about knowing what questions to ask. And the first question is always this. Where does a good investment idea come from? Chapter 1. How to generate investment ideas. Every great investment begins with a simple idea. Not a complex formula, not a secret tip, just a clear and thoughtful idea that makes sense. Most people ignore this step. They jump directly into buying stocks. They follow news headlines and social media trends. They listen to friends and experts without thinking deeply. This is where most mistakes begin. If the idea is weak, the investment will also be weak. If the idea is unclear, the decision will also be confused. A strong foundation always starts with a strong idea. So the real question is this. Where do good investment ideas come from? The answer is simpler than most people think. Good ideas come from observation, from curiosity, from paying attention to the world around you. You do not need special access or insider information. You do not need complicated tools. You only need a thinking mind and a habit of noticing things. Start with your daily life. Look at the products you use every day. Think about the services you depend on. Notice where you spend your money. Notice what other people are using and talking about. If a product is useful to you, it is likely useful to others. If a service solves your problem, it is likely solving many problems. This is often the starting point of a great investment idea. For example, you may notice that a certain brand is always busy. Customers keep coming back again and again. People trust it and recommend it to others. This is not random. This is a signal that the business might be strong. But observation alone is not enough. You must go deeper. Ask simple questions. Why do people choose this product? What makes it better than others? Is it cheaper or higher quality or more convenient? Does it solve a real problem or just a temporary need? These questions help you move from curiosity to understanding. Another powerful source of ideas is reading. Read annual reports of companies. Read business news and industry updates. Read about new technologies and changing trends. Reading expands your thinking. It exposes you to new ideas and opportunities. But do not read passively. Read with a purpose. Always ask what this information means. Always connect it to real businesses. For example, if you read about growth in digital payments, think about companies that benefit from this trend. Think about how people are changing their behavior. This is how ideas begin to form. You can also learn from other investors. Study what successful investors are buying and why. Understand their reasoning, not just their actions. Do not copy blindly. Use their ideas as a starting point for your own thinking. Remember this clearly. An idea borrowed without understanding is dangerous. An idea built through your own thinking is powerful. Another method is to study industries. Pick an industry and explore it deeply. Understand how it works. Learn about its major players. Identify its challenges and opportunities. When you understand an industry, you start seeing patterns. You notice which companies are strong and which are weak. You begin to identify potential winners. This approach takes time, but it builds deep knowledge. Sometimes ideas come from change. Change in technology, change in consumer behavior, change in regulations. Whenever change happens, new opportunities are created. For example, when people shift from offline to online shopping. Companies that support online platforms grow stronger. When new technology replaces old systems, new leaders emerge and old ones decline. If you pay attention to change, you will find ideas early. But there is an important warning here. Not every new idea is a good investment. Some ideas look exciting but lack real value. Some trends are temporary and disappear quickly. This is why patience is important. Do not rush. Let the idea develop. Observe it over time. See if it continues to make sense. A good idea becomes stronger with time. A weak idea becomes weaker. Another useful habit is to keep a list of ideas. Write down every interesting business you find. Do not worry if it is perfect or not. Just collect ideas. Over time, this list becomes valuable. You can review it and study each idea carefully. You can compare opportunities and choose wisely. This habit keeps your mind active. It turns random thoughts into structured thinking. Also learn to say no. You will see many ideas, but you do not need to act on all of them. In fact, the best investors say no most of the time. They wait for ideas that are clear and strong. They ignore noise and distractions. This discipline protects them from mistakes. Another important point is simplicity. A good investment idea should be simple to understand. If it is too complicated, it is risky. You should be able to explain the idea in a few sentences. If you cannot explain it clearly, you probably do not understand it well. Clarity leads to confidence, and confidence leads to better decisions. It is also important to stay within your circle of understanding. This means focusing on businesses you can understand. Do not chase industries that are too complex for you. For example, if you do not understand advanced technology, it is better to avoid it until you learn more. There is no shame in saying I do not know. In fact, this honesty is a strength. It keeps you safe from unnecessary risk. Over time, your circle of understanding will grow. As you learn more, you can explore new areas, but always start with what you know. Another key idea is independent thinking. The market is full of opinions. Everyone has a view about what to buy and what to sell. If you follow others blindly, you will lose your direction. You must learn to think for yourself. Listen to others, but do not depend on them. Question everything. Verify information before trusting it. This habit builds strong judgment, and strong judgment is essential for investing. Also remember that not every idea needs immediate action. Sometimes the best decision is to wait. Wait until you understand the idea fully. Wait until the opportunity becomes clear. Patience is not inactivity. It is a smart choice. It allows you to avoid mistakes and act with confidence. As you develop this process, you will notice a change. You will stop chasing random opportunities. You will start focusing on quality ideas. You will become more selective and thoughtful. This is the beginning of disciplined investing. Before moving to the next step, always ask yourself a few simple questions. Do I understand this business? Does this idea make logical sense? Can I explain it clearly to someone else? Am I relying on facts or just opinions? If the answers are not clear, you need more thinking. Do not move forward until the idea is strong, because everything that follows depends on this step. A weak idea leads to poor analysis. A strong idea leads to clear understanding. This is why generating investment ideas is not a small step. It is the foundation of the entire process. As you move forward to the next chapter, you will begin to study the business itself. But remember this, without a good idea, there is nothing to study. So take your time here. Build your thinking carefully. Develop the habit of observing and questioning. Because in the end, successful investing does not begin with numbers. It begins with a simple but powerful idea. Chapter 2. Understanding the business. The basics. Once you have a good investment idea, the next step is to understand the business deeply. This step is where many investors fail. They invest without truly knowing what the company does. They look at stock prices instead of the business behind the stock. But a stock is not just a number. It represents a real business, a business that sells products or services to customers, a business that earns money through its operations. If you do not understand the business, you are not investing. You are only guessing. So the goal of this chapter is simple, to help you understand how a business works at its core. Start with the most basic question. What does the company do? This may sound simple, but it is very powerful. Can you clearly explain what the business offers? Can you describe its main product or service? If the answer is not clear, you need to stop and learn more. Next, ask, how does the company make money? Every business has a revenue model. Some sell products directly to customers, some provide services and charge fees, some earn through subscriptions or advertisements. Understanding how money flows into the business is critical. Then ask, who are the customers? Are they individuals or businesses? Are they regular buyers or occasional users? Do they depend on the product or is it optional? A business with loyal and repeat customers is usually stronger. Now look at the value the company provides. Why do customers choose this business? Is it because of low price? Is it because of high quality? Is it because of convenience or brand trust? Every strong business offers clear value. If you cannot identify this value, the business may not be strong. Another important question is, what are the main costs of the business? Every company spends money to operate. These costs can include raw materials, salaries, marketing, and distribution. Understanding costs helps you understand profitability. A business that controls its costs well can earn higher profits. Also look at how the business operates. Does it require heavy investment in equipment or infrastructure? Or is it a light business that runs with minimal assets? Asset-heavy businesses often need more capital. Asset-light businesses can grow faster with less investment. Both can be successful, but they work differently. You must understand the nature of the business model. Another key point is revenue stability. Does the company earn consistent income? Or does revenue change frequently? Some businesses have stable demand, for example, essential goods and services. Other businesses are more cyclical. Their performance depends on economic conditions. Understanding this helps you manage risk. Also study how the business grows. Does it grow by increasing sales to existing customers? Or by finding new customers? Or by expanding into new markets? Growth methods affect the future potential of the business. Next, focus on competition. Every business faces competition. Some face intense competition. Some have limited competition due to strong advantages. Ask yourself, how easy is it for a new company to enter this market? If it is easy, competition will increase. If it is difficult, the existing company has an advantage. This concept is very important. Now think about the long-term demand. Will people continue to need this product or service? Or is it something that may disappear over time? For example, some industries grow steadily for years. Others decline as new technology replaces them. You must think about the future, not just the present. Another useful step is to simplify the business. Try to explain the entire business in a few lines. For example, this company sells affordable clothing to young customers through retail stores and online platforms. If you can explain it like this, you understand it. If not, you need more clarity. Also, try to identify the key drivers of success. What factors determine whether the business will succeed or fail? It could be pricing power. It could be customer loyalty. It could be operational efficiency. Understanding these drivers helps you focus on what matters most. Another important habit is to read company reports. Annual reports provide detailed information about the business. They explain strategy, risks, and performance. But do not just read numbers. Read the story behind the business. Pay attention to how management describes their operations. Look for clarity and honesty in their communication. Also, compare multiple companies in the same industry. This helps you understand differences in business models. You can see which company is stronger and why. Comparison builds deeper understanding. It is also important to identify risks. Every business has risks. Some are internal, like poor management. Some are external, like economic changes or regulation. Knowing the risks prepares you for uncertainty. Do not ignore risks just because the idea looks good. A complete understanding includes both strengths and weaknesses. Another key concept is scalability. Can the business grow without increasing costs too much? A scalable business can increase revenue faster than costs. This leads to higher profits over time. Many successful companies have scalable models. Also think about pricing power. Can the company increase prices without losing customers? If yes, it has a strong position. If no, it may struggle to maintain profits. Pricing power often comes from strong brand or unique value. Now consider the simplicity of operations. Simple businesses are easier to manage and understand. Complex businesses have more risks and uncertainties. As an investor, simplicity is your friend. It reduces confusion and improves decision-making. Another useful approach is to think like an owner. If you were buying the entire business, would you feel confident? Would you understand how it works? Would you trust its future? This mindset changes your perspective. You stop thinking like a trader. You start thinking like a business owner. This leads to better decisions. Also remember that understanding takes time. You cannot learn everything in one day. You need to read, think, and revisit the business multiple times. Each time, your understanding becomes deeper. Do not rush this process. Speed leads to mistakes. Patience leads to clarity. As you build this habit, you will notice something important. You will start rejecting many ideas. Because once you understand businesses deeply, you see their weaknesses clearly. This is a good sign. It means your standards are improving. You are becoming more selective. And selectivity is a key trait of successful investors. Before moving to the next chapter, ask yourself these questions. Do I understand what the company does? Do I know how it makes money? Do I understand its customers and value? Do I know its costs and risks? Can I explain the business simply? If the answer is yes, you are ready to move forward. If not, spend more time here, because this step is critical. Without understanding the business, you cannot evaluate anything else. You cannot judge its strengths. You cannot analyze its finances. You cannot trust your decision. Everything depends on this foundation. In the next chapter, you will go even deeper. You will look at the business from the customer perspective. Because in the end, every successful business depends on one thing: the customer. And understanding the customer will take your analysis to the next level. Chapter 3. Understanding the business from the customer perspective. After understanding the basics of a business, the next step is to see it through the eyes of the customer. This step is often ignored, but it is one of the most powerful ways to understand a company. A business does not exist for itself. It exists to serve customers. Without customers, there is no revenue. Without revenue, there is no business. So if you truly want to understand a company, you must understand its customers. Start with a simple question. Who is the customer? Is the customer an individual or a business? Is the product used daily or occasionally? Is it a necessity or a luxury? These questions help you define the nature of demand. Next, ask, what problem is the customer trying to solve? Every purchase is driven by a need or a desire. Sometimes it is a basic need like food or shelter. Sometimes it is convenience or comfort. Sometimes it is emotional like status or trust. A strong business solves an important problem. A weak business offers something people can easily ignore. Now think about why the customer chooses this business. There are always alternatives in the market. So why does the customer pick this one? Is it because of lower price? Is it because of better quality? Is it because of brand reputation? Is it because of convenience or accessibility? This is where you begin to understand the real strength of a business. If customers have a clear reason to choose the company, it has an advantage. If customers switch easily, it has a weakness. Another important question is customer loyalty. Do customers come back again and again? Or do they switch to competitors frequently? Loyal customers are extremely valuable. They reduce marketing costs. They provide stable revenue. They often recommend the product to others. A business with strong customer loyalty has a powerful foundation. Now, look at customer experience. How does the customer feel when using the product or service? Is the experience smooth and satisfying? Or is it confusing and frustrating? Customer experience plays a major role in long-term success. A company that consistently delivers a good experience builds trust, and trust leads to repeat business. You can learn a lot by observing real users. Read customer reviews. Talk to people who use the product. Observe how people interact with the service. These real-world insights are often more valuable than financial data. They show you the truth about the business. Another key factor is pricing from the customer point of view. How does the customer perceive the price? Is it affordable? Is it expensive but worth the value? Is it cheap but low quality? Price is not just a number. It reflects the value the customer receives. A company that provides high value can charge higher prices. A company with weak value must compete on price. Now consider switching behavior. How easy is it for a customer to switch to another option? If switching is easy, the company must constantly compete. If switching is difficult, the company has an advantage. For example, if a service becomes part of daily routine, or if it requires time and effort to change, customers are less likely to switch. This creates stability for the business. Another important concept is customer dependency. Does the customer depend heavily on the product? Or is it something they can live without? Essential products create stronger demand. Optional products face more uncertainty. Understanding this helps you judge the reliability of revenue. Also think about how customers discover the product. Do they find it through advertising? Through word of mouth? Through online platforms? A business that relies heavily on advertising may need constant spending. A business that grows through word of mouth has stronger organic demand. This difference affects long-term profitability. Now focus on customer segments. Not all customers are the same. Some may be price-sensitive. Some may care more about quality. Some may look for convenience. A good business understands its target customers clearly. It focuses on serving them better than anyone else. If a company tries to serve everyone, it may end up serving no one well. Another key idea is customer lifetime value. This means how much value a customer brings over time. A customer who buys repeatedly is more valuable than one who buys once. A business that retains customers can grow more efficiently. Retention is often more important than acquisition. Now consider feedback and improvement. Does the company listen to its customers? Does it improve its product based on feedback? A business that adapts to customer needs stays relevant. A business that ignores feedback becomes outdated. Adaptability is a strong advantage. Also observe how customers talk about the brand. Do they trust it? Do they recommend it? Do they complain about it? Brand perception is built through customer experience. A strong brand makes it easier to attract and retain customers. Another useful step is to try the product yourself. Use the service if possible. Experience it like a real customer. This gives you direct insight. It helps you understand what works and what does not. Sometimes this simple step reveals more than detailed reports. Now think about the emotional connection. Some businesses create strong emotional bonds. Customers feel attached to the brand. This connection is powerful. It creates loyalty that goes beyond price or features. Companies with strong emotional connection often have long-term advantages. Also consider the frequency of use. Is the product used daily, weekly, or rarely? Frequent use increases customer engagement. It keeps the brand in the customer's mind. This often leads to higher loyalty and consistent revenue. Now look at customer complaints. No business is perfect, but how a company handles complaints is important. Does it respond quickly? Does it solve problems effectively? Good service during problems builds trust. Poor service destroys it. Another key factor is convenience. In today's world, convenience matters a lot. Customers prefer solutions that save time and effort. A business that makes life easier for customers has a strong advantage. This could be through better technology, better service, or better accessibility. Now think about trends in customer behavior. Are customer preferences changing? Are new habits forming? For example, people may shift to digital services. They may prefer faster delivery. They may value sustainability. Businesses that align with these trends grow faster. Those that ignore them fall behind. Understanding trends helps you see the future. Another important idea is trust. Trust is the foundation of every strong customer relationship. Customers must believe that the product will deliver what it promises. If trust is broken, customers leave. Building trust takes time. Losing it takes moments. Companies that protect trust create lasting value. Now combine all these insights. Try to form a clear picture of the customer relationship. Ask yourself, do customers truly value this product? Do they return again and again? Do they trust the brand? Is the experience positive? Is the demand likely to continue? If the answers are strong, the business has a solid customer foundation. If the answers are weak, you must be careful. Because no matter how strong the financial numbers look, without happy customers, the business cannot survive long-term. This perspective changes how you see investing. You move from numbers to real life, from data to human behavior. And this gives you a deeper understanding. As you practice this approach, you will notice patterns. You will start identifying businesses with strong customer connections. You will avoid businesses that depend only on temporary demand. This improves your decision-making significantly. Before moving to the next chapter, reflect on these questions. Do I understand who the customers are? Do I know why they choose this business? Do I see evidence of loyalty and trust? Do I understand their experience and behavior? If yes, you are ready to go deeper. In the next chapter, you will evaluate the strengths and weaknesses of the business and its industry. Because once you understand the customer, you are ready to judge how strong the business truly is. Chapter 4. Evaluating the strengths and weaknesses of a business and industry. After understanding the customer, the next step is to evaluate how strong the business really is. This means looking at both strengths and weaknesses. It also means understanding the industry in which the company operates. A business does not operate alone. It exists within an industry. It faces competitors. It deals with suppliers and regulations. So to judge a company properly, you must look at the bigger picture. Start with strengths. Every successful business has something that gives it an advantage. This advantage helps it earn profits and survive competition. Ask yourself a simple question. What makes this business special? It could be a strong brand. It could be low-cost operations. It could be unique technology. It could be excellent customer service. These strengths are often called competitive advantages. A business with strong advantages can protect its position. A business without advantages struggles to survive. One common strength is brand power. When customers trust a brand, they prefer it over others. They are willing to pay more. They return again and again. Brand reduces competition. It creates loyalty and stability. Another strength is cost advantage. Some companies can produce goods at lower cost than others. This allows them to offer lower prices or earn higher profits. Cost advantage is powerful, especially in price-sensitive markets. Next is network effect. This happens when a product becomes more valuable as more people use it. For example, a platform with many users attracts even more users. This creates a strong barrier for new competitors. Another strength is switching cost. If it is difficult or costly for customers to switch, they are more likely to stay with the company. This creates stable revenue. Switching cost can come from habit, from contracts, or from integration with other systems. Now consider distribution strength. Some companies have strong distribution networks. They can reach customers easily and quickly. This gives them an advantage over competitors. For example, a company with wide retail presence can dominate the market. Next, think about operational efficiency. Some businesses run more efficiently than others. They manage resources better. They reduce waste. They improve productivity. Efficiency leads to better margins and stronger performance. Now, move to weaknesses. Every business has weaknesses. Ignoring them is dangerous. Ask yourself, where can this business fail? One weakness could be high dependence on a single product. If that product loses demand, the company suffers. Another weakness could be high debt. Debt increases risk, especially during tough times. A company with heavy debt may struggle to survive downturns. Next, consider management weaknesses. Poor decisions can damage even a strong business. If management lacks discipline or vision, the company may lose its advantage. Another weakness is intense competition. If many companies offer similar products, it becomes difficult to stand out. This leads to price wars and lower profits. Now shift your focus to the industry. Understanding the industry is as important as understanding the company. Start by asking, is this a growing industry or a declining one? Growing industries offer more opportunities. Declining industries face constant pressure. Next, look at competition level. Is the industry highly competitive or dominated by a few strong players? High competition reduces profitability. Low competition allows companies to earn higher returns. Also consider barriers to entry. How easy is it for new companies to enter the industry? If entry is easy, new competitors will appear. This increases competition. If entry is difficult, existing companies are protected. Barriers can come from capital requirements, from regulation, from brand strength, or from technology. Another important factor is supplier power. Suppliers provide raw materials or services. If suppliers are strong, they can increase prices. This reduces company profits. If suppliers are weak, companies have more control. Now think about customer power. Customers also influence the business. If customers have many choices, they can demand lower prices. If choices are limited, companies have more pricing power. Next, consider substitutes. Substitutes are alternative solutions to the same problem. For example, digital services can replace physical products. If strong substitutes exist, the business faces risk. Now look at industry trends. Industries change over time. New technology can transform the market. Consumer preferences can shift. Regulations can change. A business must adapt to these changes. Companies that adapt survive and grow. Those that resist change decline. Another key factor is industry profitability. Some industries are naturally more profitable than others. For example, industries with strong brand and low competition often have high profits. Industries with intense competition and low differentiation have low profits. Understanding this helps you set realistic expectations. Now combine business and industry analysis. A strong company in a weak industry may struggle. A weak company in a strong industry may survive but not excel. The best situation is a strong company in a strong industry. This combination creates powerful opportunities. Another important idea is durability of advantage. Not all strengths last forever. Some advantages are temporary. Others are long-lasting. Ask yourself, how long can this company maintain its advantage? If the advantage is durable, the business has long-term potential. If it is temporary, the future is uncertain. Now think about risk and reward together. A business with strong advantages and low risk is valuable. A business with many weaknesses is risky. You must balance both. Do not focus only on strengths. Do not ignore weaknesses. A clear view requires both sides. Also remember that no business is perfect. Every company has some weakness. Your goal is not to find perfection. Your goal is to find businesses where strengths outweigh weaknesses. Another useful approach is comparison. Compare the company with its competitors. Look at differences in cost structure. Look at differences in customer loyalty. Look at differences in growth and profitability. Comparison reveals true strengths and weaknesses. It helps you see which company stands out. Also pay attention to consistency. Strong businesses perform well over time. Weak businesses show unstable results. Consistency is a sign of strength. Now consider scalability again in this context. Can the company expand its advantage as it grows? Some businesses become stronger as they grow. Others become more complex and less efficient. Understanding this helps you predict future performance. Another key point is resilience. How does the business perform during difficult times? Does it survive economic downturns? Does it recover quickly? Resilient businesses are more reliable. Now take a step back and think clearly. You have looked at strengths. You have looked at weaknesses. You have studied the industry. Now form a balanced view. Ask yourself, is this business truly strong? Does it have clear advantages? Are its weaknesses manageable? Is the industry supportive? If the answers are positive, you are moving in the right direction. If not, you must be cautious. Because a poor understanding at this stage can lead to bad decisions. As you practice this analysis, you will become more confident. You will start seeing patterns. You will recognize strong businesses quickly. You will avoid weak ones naturally. This skill improves with time and experience. Before moving to the next chapter, reflect on these questions. What are the key strengths of the business? What are the major weaknesses? How strong is the industry? Is the advantage durable? Does the company stand out among competitors? If you can answer these clearly, you are ready to move forward. In the next chapter, you will measure the operating and financial health of the business. Because after understanding the qualitative side, it is time to look at the numbers that support the story. Chapter 5. Measuring the operating and financial health of the business. After understanding the business, its customers, and its strengths and weaknesses, the next step is to measure its health through numbers. Numbers tell the story of what is really happening inside the business. They show whether the company is strong or struggling. They reveal patterns that may not be visible at first glance. But numbers must be understood carefully. Looking at them without context can be misleading. So the goal is not just to see numbers. The goal is to understand what they mean. Start with revenue. Revenue is the total money a company earns from its operations. It shows the size of the business activity. Ask yourself, is revenue growing over time? Is the growth consistent or irregular? Steady growth is a positive sign. It shows increasing demand and business expansion. But sudden spikes or drops require attention. They may indicate instability or one-time events. Next, focus on profit. Revenue alone is not enough. A company must convert revenue into profit. Profit shows how efficiently the business operates. Look at gross profit first. Gross profit is the difference between revenue and direct costs. It shows how much the company earns from its core activity. A strong gross profit indicates good pricing or cost control. Then look at operating profit. Operating profit includes other business expenses. It shows how well the company manages its operations. Consistent operating profit is a sign of a healthy business. Finally, look at net profit. Net profit is what remains after all expenses. It is the final earning of the company. But do not focus only on one number. Look at trends over time. Consistency is more important than one good year. Now consider profit margins. Margins show the percentage of profit relative to revenue. Higher margins mean the company keeps more of what it earns. Lower margins mean higher costs or pricing pressure. Stable or improving margins are positive. Declining margins may signal problems. Next, examine return on capital. This measures how effectively the company uses its resources. A business that generates high returns on capital is efficient. It creates more value from each unit of investment. Low returns may indicate poor management or weak business model. Now focus on cash flow. Cash flow is one of the most important measures of health. Profit can sometimes be adjusted through accounting, but cash is real. Look at operating cash flow. This shows how much cash the business generates from its operations. Strong and consistent operating cash flow is a good sign. Next, look at free cash flow. Free cash flow is the cash remaining after necessary investments. This is the money the company can use for growth or distribution. A company with strong free cash flow has flexibility. It can invest, expand, or return money to shareholders. Now consider debt. Debt can help a company grow, but too much debt increases risk. Look at the level of debt compared to earnings. If debt is high and earnings are unstable, the company may face difficulties. Also check the ability to repay debt. Can the company generate enough cash to meet its obligations? Strong businesses manage debt carefully. They do not depend heavily on borrowing. Next, examine liquidity. Liquidity shows the company's ability to meet short-term obligations. A company should have enough resources to cover its immediate needs. If liquidity is weak, the company may struggle even if it is profitable. Now, look at efficiency ratios. These show how well the company uses its assets. For example, how quickly it sells inventory, how efficiently it collects payments from customers. Efficient operations improve cash flow and profitability. Next, consider growth in earnings. Is the company increasing its profits over time? Growth should be supported by real business improvement, not by temporary factors. Sustainable growth is more valuable than rapid but unstable growth. Also pay attention to consistency. A healthy business shows stable performance across years. Frequent fluctuations may indicate underlying issues. Consistency builds confidence in future performance. Now compare the company with others in the same industry. Numbers alone do not mean much without comparison. A margin that looks good in one industry may be average in another. Comparison helps you understand relative performance. Next, analyze trends over a long period. Do not rely on 1 or 2 years of data. Look at performance over many years. This reveals patterns and reduces the impact of temporary events. Now think about quality of earnings. Not all earnings are equal. Some earnings come from core operations. Others come from one-time events. Focus on recurring earnings. These are more reliable and sustainable. Now consider capital allocation. How does the company use its profits? Does it reinvest in the business? Does it reduce debt? Does it return money to shareholders? Good capital allocation creates long-term value. Poor allocation destroys value. Also look at cost structure. Understand fixed and variable costs. Fixed costs remain constant regardless of sales. Variable costs change with production. A business with high fixed costs may struggle during downturns. A business with flexible costs can adjust more easily. Now think about scalability in financial terms. As revenue grows, do profits grow faster? If yes, the business has operating leverage. This means it becomes more profitable as it expands. Now examine warning signs: declining revenue, falling margins, increasing debt, weak cash flow. These signals should not be ignored. They may indicate deeper problems. Also be cautious of overly complex financial reports. Complexity can hide risks. Simple and transparent reporting is easier to trust. Now connect numbers with business understanding. Do the numbers match what you expect from the business? If the business seems strong but numbers are weak, there may be a problem. If numbers are strong but business understanding is unclear, you need to investigate further. Alignment between story and numbers is important. Another key idea is predictability. Can you reasonably predict future performance based on past data? Stable businesses are easier to predict. Unstable businesses carry more uncertainty. Predictability reduces risk. Now take a holistic view. Do not focus on one metric. Look at the complete picture. Revenue growth, profitability, cash flow, debt, efficiency. All together, they tell the story. As you develop this skill, you will become more confident. Numbers will start making sense. You will see patterns and relationships. This ability is essential for making informed decisions. Before moving to the next chapter, ask yourself, is the company financially strong? Does it generate consistent profits and cash flow? Is debt under control? Are margins stable or improving? Do the numbers support the business story? If the answers are clear, you are ready to go deeper. In the next chapter, you will evaluate how the company uses its earnings. Because earning money is only one part. How that money is used determines long-term success. Chapter 6. Evaluating the distribution of earnings cash flows. After understanding the financial health of a business, the next step is to examine how the company uses the money it earns. This is one of the most important parts of investing, because a company can earn profits but still destroy value if it uses that money poorly. Earnings alone do not create wealth. The way those earnings are distributed and allocated determines long-term success. So the focus of this chapter is simple. Follow the money. See where it goes. Understand how it is used. Start with a basic question. What happens to the money after the company earns it? There are several possibilities. The company can reinvest it in the business. The company can pay dividends to shareholders. The company can buy back its own shares. The company can reduce debt. Or the company can make acquisitions. Each of these choices has different consequences. A good management team allocates capital wisely. A poor management team wastes resources. So you must study this carefully. Begin with reinvestment. Reinvestment means putting money back into the business. This can include expanding operations, developing new products, improving technology, entering new markets. Reinvestment is important for growth, but not all reinvestment is good. Ask yourself, is the company earning good returns on its investments? If the company invests 1 unit of money, does it generate more than 1 unit in return over time? If yes, reinvestment creates value. If not, it destroys value. Some companies keep investing without clear results. They grow in size but not in profitability. This is a warning sign. Now consider dividends. Dividends are payments made to shareholders. They represent a direct return of profits. Dividends are useful when the company has limited growth opportunities. Instead of wasting money, management returns it to investors. But very high dividends may also indicate limited future growth. So balance is important. Next, look at share buybacks. This is when a company buys its own shares from the market. Buybacks reduce the number of shares. This increases ownership for remaining shareholders. If done at the right price, buybacks create value. If done at high prices, they destroy value. So timing and discipline matter. Now examine debt repayment. If a company has debt, it may use earnings to reduce it. Reducing debt lowers financial risk. It strengthens the balance sheet. This is often a good use of cash, especially if debt levels are high. Next, consider acquisitions. Companies sometimes use earnings to buy other businesses. Acquisitions can help growth. They can expand market reach. They can add new capabilities. But many acquisitions fail. They may be overpriced. They may not fit well with the existing business. So you must evaluate acquisitions carefully. Now, shift your focus to cash flow. Cash flow shows the real movement of money. Profit can be influenced by accounting methods. But cash flow shows actual liquidity. Start with operating cash flow. This is the cash generated from core business operations. A healthy business should generate strong operating cash flow. If profits are high but cash flow is weak, this may indicate problems. Next, look at investing cash flow. This shows how much money is being used for investments. Large investments may indicate growth plans, but they must be evaluated for effectiveness. Now examine free cash flow. Free cash flow is the most important measure. It is the cash remaining after necessary investments. This is the money available for distribution. Strong free cash flow gives the company flexibility. It can choose how to allocate resources. Weak free cash flow limits options. Now think about consistency. Does the company generate cash flow regularly? Consistency is a sign of strength. Irregular cash flow increases uncertainty. Also, compare earnings with cash flow. Do they move together? If earnings grow but cash flow does not, this may indicate aggressive accounting. Alignment between earnings and cash flow is important. Now focus on capital allocation decisions over time. Look at how management has used money in the past. Have they created value? Or have they made poor decisions? Past behavior often predicts future actions. If management has a history of smart allocation, you can have more confidence. If not, you must be cautious. Another key concept is return on reinvested capital. This measures how effectively new investments generate returns. High returns indicate strong opportunities. Low returns indicate limited potential. Companies with high returns can grow efficiently. They do not need large amounts of capital. Now consider opportunity cost. Every decision has a cost. If a company uses money for one purpose, it cannot use it for another. So management must choose wisely. For example, investing in a low-return project means missing a high-return opportunity. Understanding opportunity cost helps you evaluate decisions better. Next, examine payout policy. This includes dividends and buybacks. Is the policy consistent? Is it aligned with business needs? A disciplined policy reflects good management. Now think about balance between growth and return. Some companies focus on growth. They reinvest most of their earnings. Others focus on returning cash to shareholders. Neither approach is right or wrong. The key is whether the approach makes sense for the business. A growing company should reinvest wisely. A mature company should return excess cash. Now look for warning signs. Excessive spending without results. Frequent acquisitions without clear benefits. Rising debt despite strong earnings. Low or declining cash flow. These signals indicate poor capital allocation. Another important factor is transparency. Does management clearly explain how it uses money? Transparent communication builds trust. Lack of clarity raises concerns. Now connect this with your earlier analysis. Does the allocation of earnings match the business strengths? For example, a company with strong growth opportunities should reinvest. A company with limited growth should return cash. Alignment between strategy and allocation is important. Now consider long-term impact. Good allocation decisions create compounding value. Over time, small improvements lead to large results. Poor decisions also compound, but in a negative way. They reduce value year after year. This is why this chapter is critical, because it determines how value is created over time. Now take a practical approach. When analyzing a company, review several years of data. Look at how earnings have been used. Look at the results of those decisions. This gives you a clear picture of management quality. Also compare with other companies. See how different management teams allocate capital. This comparison helps you identify best practices. Another useful habit is to think like an owner again. If this were your business, how would you use the money? Would you reinvest? Would you reduce debt? Would you return cash? This perspective improves your judgment. Now reflect on discipline. Good capital allocation requires discipline. It requires saying no to bad opportunities. It requires patience to wait for good ones. Discipline separates great companies from average ones. Now summarize your understanding. Ask yourself, does the company generate strong cash flow? Does it allocate capital wisely? Are investments creating value? Is management disciplined and transparent? If the answers are positive, the business has a strong foundation. If not, you must be careful, because even a good business can fail with poor capital allocation. As you move to the next chapter, you will focus on management more deeply, because ultimately capital allocation decisions are made by people, and understanding those people is essential. In the next chapter, you will study management background and classification. You will ask a simple but powerful question: who are they? Because behind every decision, behind every success or failure, there is always management. Chapter 7. Assessing the quality of management background and classification. Who are they? After understanding how a company uses its earnings, the next step is to understand the people making those decisions. Because every action taken by a company comes from its management. A strong business can be damaged by poor leadership. A weak business can improve under strong leadership. So understanding management is not optional. It is essential. Start with a simple question. Who are they? This question may seem basic, but it is very powerful. You must know the people running the company. You must understand their background. You must study their experience and behavior. Begin with the leadership team. Look at the chief executive officer. Look at key executives. What is their history? Where have they worked before? What roles have they held? Experience matters. Leaders who have faced challenges and solved problems are often more capable. They have learned from real situations. But experience alone is not enough. You must also understand the type of management you are dealing with. Different managers have different styles. Some are owners. Some are professional managers. Owner managers have a significant stake in the business. Their personal wealth is linked to company performance. This often aligns their interests with shareholders. Professional managers may not have large ownership. They are hired to run the company. Their incentives may be different. Neither type is automatically good or bad, but understanding the difference is important. Now look at ownership structure. How much of the company is owned by management? High ownership can create strong alignment. Low ownership may reduce accountability. But too much control can also be risky. If one person has too much power, it may lead to poor decisions without checks. Balance is important. Next, examine the history of decision-making. What major decisions has management made in the past? Have they created value? Or have they made costly mistakes? Past actions reveal true capability. Words can be convincing, but actions show reality. Now consider integrity. Integrity is one of the most important qualities. A manager may be skilled, but without honesty, that skill becomes dangerous. Look for signs of honesty and transparency. Do they communicate clearly with investors? Do they admit mistakes? Do they provide realistic expectations? Or do they avoid difficult questions? Do they present overly optimistic views? Trust is built through consistent behavior. Once broken, it is difficult to restore. Now focus on communication style. Read annual reports and management discussions. How do they explain the business? Is the language clear and simple? Or is it complex and confusing? Clear communication often reflects clear thinking. Confusing communication may hide problems. Also observe how management talks about risks. Do they openly discuss challenges? Or do they ignore them? Honest leaders acknowledge risks. They prepare for them. Next, think about long-term versus short-term focus. Does management focus on long-term value? Or do they chase short-term results? Short-term focus may boost immediate performance, but it often harms long-term growth. Long-term thinking builds sustainable success. Now examine incentives. How is management rewarded? Are rewards based on long-term performance or short-term targets? Incentives shape behavior. If rewards are tied to short-term results, management may take risky actions. If rewards are aligned with long-term value, decisions are more thoughtful. Next, consider reputation. What do others say about management? Look at opinions from industry experts. Look at feedback from employees. While not always perfect, these insights can be useful. Reputation is built over time. It reflects consistent behavior. Now classify management type more deeply. Some managers are operators. They focus on running the business efficiently. They improve processes and reduce costs. Others are capital allocators. They focus on how money is used. They decide where to invest and where to reduce spending. Some are visionaries. They focus on long-term direction. They create new opportunities and ideas. The best management teams combine these qualities, but often one strength dominates. Understanding this helps you evaluate their decisions. Now consider succession planning. What happens if current leaders leave? Is there a clear plan for replacement? A company should not depend on one individual. Strong organizations prepare for leadership changes. This ensures continuity. Next, look at board of directors. The board provides oversight. Are board members independent? Do they have relevant experience? A strong board can guide and monitor management. A weak board may fail to prevent poor decisions. Now think about culture. Management shapes company culture. Culture influences how employees behave. It affects productivity and innovation. A positive culture supports growth. A negative culture creates problems. You can often sense culture through employee reviews and company actions. Next, consider adaptability. Can management adapt to change? Markets evolve. Technology advances. Customer preferences shift. Leaders must respond to these changes. Rigid management may struggle. Flexible management can adjust and grow. Now examine risk management. How does management handle risk? Do they take excessive risks? Or are they too conservative? Balanced risk-taking is important. Too much risk can lead to failure. Too little risk can limit growth. Next, observe consistency. Do management actions match their statements? Consistency builds trust. Inconsistency raises doubts. Now connect management with previous chapters. Does management understand the business well? Do they focus on customers? Do they strengthen competitive advantages? Do they allocate capital wisely? Alignment across all areas is important. Now think about accountability. Does management take responsibility for results? Do they acknowledge failures? Do they learn from mistakes? Accountable leaders improve over time. Next, consider transparency in financial reporting. Are reports clear and honest? Do they provide enough detail? Or do they hide important information? Transparency reduces uncertainty. Now evaluate overall quality. Bring all factors together. Background, experience, integrity, communication, decision-making, incentives. Form a complete view. Ask yourself, do I trust this management? Do they act in the best interest of the business? Do they have the ability to create value? If the answer is yes, you have a strong foundation. If not, you must be cautious, because management quality affects every aspect of the business. As you practice this analysis, you will become more skilled. You will learn to read between the lines. You will recognize strong leadership quickly. This skill is one of the most valuable in investing. Before moving to the next chapter, reflect on these questions. Who are the leaders of this company? What is their background and experience? Do they have integrity and transparency? Are their incentives aligned with long-term value? Do their actions match their words? If you can answer these clearly, you are ready to go deeper. In the next chapter, you will assess management competence. You will move from who they are to how they actually run the business, because identity is important. But performance reveals the truth. Chapter 8. Assessing the quality of management competence. How management operates the business. After understanding who the managers are, the next step is to evaluate how they actually run the business. Background tells you where they come from. Competence tells you what they can do. This is where real judgment begins. A manager may have an impressive history, but what matters is performance in the present. So you must study how management operates the business on a daily basis. Start with a simple question. How well does management execute? Execution is the ability to turn plans into results. Many companies have good ideas, but only a few can execute them effectively. Look at operational performance over time. Is the business improving? Are revenues growing steadily? Are costs being controlled? Consistent improvement is a sign of strong execution. Now, examine decision-making. Every business faces choices: where to invest, where to cut costs, which markets to enter. Good management makes thoughtful decisions. They analyze data. They consider risks. They act with discipline. Poor management makes reactive decisions. They follow trends without deep thinking. They change direction frequently. Consistency in decision-making is important. Next, focus on capital allocation in practice. You have already studied where money goes. Now, look at how those decisions are made. Are investments well planned? Do they generate expected returns? Competent managers allocate capital with care. They do not rush into opportunities. They evaluate each option carefully. Now consider operational efficiency again from management perspective. Do managers improve processes over time? For example, do they reduce waste? Do they increase productivity? Continuous improvement is a sign of strong competence. It shows that management is focused on excellence. Now examine how management handles growth. Growth can be challenging. As a business expands, complexity increases. Competent managers maintain control during growth. They build systems. They hire the right people. They maintain quality. Incompetent managers lose control. Quality declines. Costs increase. So growth management is a key test. Next, look at problem-solving ability. Every business faces problems. Market changes, operational issues, unexpected challenges. Competent managers respond quickly and effectively. They identify root causes. They implement solutions. Poor managers delay action. They ignore problems until they become serious. Now observe adaptability. Markets are constantly changing. New competitors appear. Technology evolves. Customer preferences shift. Competent management adapts to change. They update strategies. They invest in new opportunities. Rigid management resists change. This leads to decline over time. Now consider innovation. Does management encourage new ideas? Innovation is not only about technology, it is also about improving processes and services. Companies that innovate stay competitive. Management plays a key role in creating this environment. Now focus on communication within the organization. How does management communicate with employees? Clear communication improves coordination. It aligns everyone with company goals. Poor communication creates confusion. It reduces efficiency. Now examine talent management. A company is only as strong as its people. Competent managers attract and retain talented employees. They build strong teams. They develop future leaders. Weak managers fail to build talent. This limits growth. Now consider strategic thinking. Does management have a clear strategy? Do they know where the company is heading? Strategy should be logical and consistent. Frequent changes in strategy may indicate lack of direction. Now evaluate risk management in operations. How does management balance risk and reward? Do they take calculated risks? Or do they act without proper analysis? Competent managers understand risks. They prepare for uncertainties. Now look at execution speed. Speed matters in business, but speed without thinking can be dangerous. Competent managers balance speed and accuracy. They act quickly when needed, but they do not rush blindly. Now examine resource utilization. How effectively does management use available resources? This includes money, time, and people. Efficient use of resources improves performance. Wasteful use reduces profitability. Now consider consistency in operations. Does the company deliver consistent results? Consistency reflects strong processes and discipline. Inconsistent performance may indicate weak control. Now connect management competence with customer perspective. Are customers satisfied? Does management focus on improving customer experience? Competent managers understand that customers drive success. Now connect with financial performance. Do operational improvements reflect in numbers? Revenue growth, profit margins, cash flow. These should improve under strong management. If operations seem strong but numbers do not improve, there may be a gap. Now observe long-term performance. Competence is best judged over time. Short-term success can be due to luck. Long-term success reflects true ability. Look at performance over several years. Now think about discipline. Do managers stick to their principles? Do they avoid unnecessary risks? Discipline ensures stability. Now consider transparency in operations. Do managers clearly explain their actions? Do they provide insights into business decisions? Transparency builds confidence. Now evaluate accountability again in operational context. Do managers take responsibility for results? Do they correct mistakes quickly? Accountable leaders improve continuously. Now examine alignment with company goals. Are all actions aligned with long-term objectives? Misalignment leads to inefficiency. Competent managers ensure alignment across the organization. Now think about scalability of operations. Can the management handle larger scale effectively? Some managers perform well at small scale, but struggle as the company grows. Scalability is an important test. Now observe resilience in operations. How does management perform during difficult periods? Do they maintain stability? Do they recover quickly? Resilient management adds strength to the business. Now consider ethical operations. Do managers operate with integrity in daily activities? Ethical behavior builds trust with customers and partners. Unethical behavior creates long-term risks. Now bring all observations together. You have looked at execution, decision-making, efficiency, growth management, problem-solving, adaptability, innovation, communication, talent management, strategy, risk management. Now form a complete view. Ask yourself, is management competent in running the business? Do they execute plans effectively? Do they improve performance over time? Do they handle challenges well? If the answers are positive, the business is in capable hands. If not, you must be cautious, because even a strong business can fail with weak execution. As you practice this analysis, you will develop sharper judgment. You will learn to distinguish between good and average management. This skill is essential for long-term investing success. Before moving to the next chapter, reflect on these questions. Does management execute effectively? Do they allocate resources wisely? Do they adapt to change? Do they improve operations continuously? Do their actions lead to strong results? If you can answer these clearly, you are ready to go deeper. In the next chapter, you will explore management traits. You will study positive and negative characteristics. Because beyond skills, behavior and mindset also shape outcomes. Chapter 9. Assessing the quality of management. Positive and negative traits. After understanding who management is and how they operate the business, the next step is to study their behavior and mindset. Because beyond skills and experience, traits shape decisions. Traits influence actions. Traits determine long-term outcomes. Two managers may have the same knowledge, but different traits can lead to very different results. So in this chapter, you will focus on identifying positive and negative traits in management. Start with a simple idea. Behavior reveals character. You must observe how management behaves over time, not just what they say, but what they do. Begin with positive traits. One of the most important traits is integrity. Integrity means honesty and strong moral principles. Managers with integrity are transparent. They communicate truthfully. They do not hide problems. They act in the best interest of the business and shareholders. Without integrity, no other trait matters. Now consider discipline. Disciplined managers follow a clear process. They do not make random decisions. They stick to their strategy. They avoid unnecessary risks. Discipline brings consistency. Next is patience. Good managers understand that results take time. They do not chase quick gains. They focus on long-term value. Patience allows them to make better decisions. Now think about rational thinking. Rational managers base decisions on logic and evidence. They do not let emotions control them. They analyze situations carefully. They consider multiple outcomes. This leads to better judgment. Another positive trait is humility. Humble managers accept that they do not know everything. They listen to others. They learn from mistakes. They are open to new ideas. Arrogant managers ignore feedback. This leads to poor decisions. Now consider accountability. Accountable managers take responsibility for their actions. They do not blame others. They learn from failures. This trait builds trust and improvement. Next is adaptability. Adaptable managers respond to change effectively. They adjust strategies when needed. They embrace new opportunities. This helps the business stay relevant. Now focus on long-term thinking. Managers with long-term vision prioritize sustainable growth. They invest in the future. They avoid short-term actions that harm long-term value. This trait is critical for compounding success. Another positive trait is focus. Focused managers concentrate on core strengths. They do not spread resources too thin. They avoid distractions. Focus leads to efficiency and clarity. Now consider communication honesty. Good managers communicate clearly and honestly. They explain decisions. They share both good and bad news. This builds confidence among investors and employees. Next, think about fairness. Fair managers treat all stakeholders properly. They respect employees. They value customers. Fairness creates a healthy environment. Now move to negative traits. One of the most dangerous traits is overconfidence. Overconfident managers believe they cannot fail. They take excessive risks. They ignore warning signs. This often leads to major losses. Next is greed. Greedy managers focus on personal gain. They may misuse company resources. They may prioritize short-term profits over long-term health. Greed destroys trust. Now consider lack of transparency. Some managers hide information. They avoid difficult questions. They present incomplete data. This creates uncertainty and risk. Another negative trait is inconsistency. Inconsistent managers change decisions frequently. They lack clear direction. This creates confusion within the organization. Now think about short-term focus. Managers who focus only on immediate results may ignore long-term consequences. They may cut essential investments. They may take actions that boost short-term numbers but harm future growth. Next is resistance to change. Rigid managers stick to old methods. They ignore new trends. They fail to adapt. This leads to decline over time. Now consider poor communication. Managers who communicate poorly create confusion. Employees may not understand goals. Investors may lose confidence. Clear communication is essential. Another negative trait is lack of accountability. Some managers avoid responsibility. They blame external factors. They do not learn from mistakes. This prevents improvement. Now think about empire building. Some managers focus on expanding the size of the company. They pursue growth for the sake of growth. They may make unnecessary acquisitions. This increases complexity and risk. Next is neglect of core business. Managers may get distracted by new opportunities. They may ignore the main business. This weakens the foundation. Now consider poor capital discipline. Some managers invest without proper analysis. They waste resources. This reduces returns and value. Another negative trait is lack of focus on customers. Managers who ignore customer needs lose competitive advantage. Customers move to better alternatives. Now observe patterns of behavior. Traits are not shown in one action. They appear consistently over time. You must look at long-term patterns. Now, connect traits with outcomes. Do positive traits lead to strong performance? Do negative traits lead to problems? This connection helps you evaluate management more accurately. Also consider cultural impact. Management traits influence company culture. Positive traits create a healthy culture. Negative traits create a toxic environment. Culture affects performance and growth. Now think about signals in communication. Read management letters carefully. Do they take responsibility? Do they discuss failures openly? Language reveals mindset. Now consider decision history again. Do decisions reflect discipline and rational thinking? Or do they show impulsive behavior? Past actions are strong indicators of traits. Another useful approach is comparison. Compare management with leaders of other companies. This helps you identify strengths and weaknesses. Now reflect on alignment with shareholders. Do management traits support shareholder interests? Or do they conflict? Alignment is essential for trust. Now consider stress situations. How does management behave during crises? Stress reveals true character. Calm and rational behavior is a positive sign. Panic or denial is a warning sign. Now bring all insights together. You have identified positive traits. You have identified negative traits. Now form a balanced view. Ask yourself, does management demonstrate integrity and discipline? Are they patient and rational? Do they show humility and accountability? Are negative traits limited or controlled? If positive traits dominate, management is likely strong. If negative traits dominate, risk increases significantly. As you practice this analysis, you will become more observant. You will notice subtle behaviors. You will understand how traits influence decisions. This skill will improve your investment judgment. Before moving to the next chapter, reflect on these questions. What are the key positive traits of management? What are the main negative traits? Do their actions reflect discipline and integrity? Do they focus on long-term value? Are their behaviors consistent over time? If you can answer these clearly, you are ready to move forward. In the next chapter, you will evaluate growth opportunities. Because after understanding management, you must assess the future potential of the business. Growth determines how value can expand over time. Chapter 10. Evaluating growth opportunities. After understanding the business, the customer, the industry, and the management, the next step is to look forward. You must ask a critical question. Can this business grow in the future? Growth is one of the main drivers of long-term investment returns. A company that can grow steadily creates increasing value over time. A company that cannot grow may still survive, but its potential is limited. So, evaluating growth opportunities is essential. Start with a simple idea. Growth must be realistic and sustainable. Not all growth is good. Fast growth without strong foundation can lead to problems. So your goal is not to find the fastest growing company. Your goal is to find a company that can grow in a healthy and durable way. Begin with current growth. Look at how the company has grown in the past. Has revenue increased over time? Have profits grown consistently? Past growth provides useful clues. But it is not enough. You must understand the drivers of growth. Ask yourself, what is causing this growth? Is it increased demand? Is it expansion into new markets? Is it new products or services? Understanding the source of growth helps you judge its sustainability. Now consider market size. How large is the market the company operates in? A small market limits growth potential. A large market offers more opportunities, but size alone is not enough. You must also consider market growth rate. Is the market itself expanding, or is it stable or declining? A growing market makes it easier for companies to grow. A shrinking market creates challenges. Now think about market share. How much of the market does the company control? If the company already has a large share, future growth may be slower. If the share is small, there may be room to expand. but increasing market share requires strong competitive advantages. Next, consider product expansion. Can the company introduce new products or services? New offerings can drive growth, but they must be aligned with customer needs. Successful expansion builds on existing strengths. Now think about geographic expansion. Can the company enter new regions or countries? This can increase the customer base. But expansion comes with challenges. Different markets have different conditions, so management must execute carefully. Now consider pricing power. Can the company increase prices over time? If yes, revenue can grow even without increasing volume. Pricing power often comes from strong brand or unique value. Now focus on customer growth. Can the company attract new customers? Is there a large untapped audience? Customer acquisition is a key driver of growth, but it must be cost-effective. High acquisition costs can reduce profitability. Now consider customer retention. Retaining customers is often easier than acquiring new ones. A business with strong retention can grow steadily. Repeat customers create stable revenue. Now think about innovation. Can the company innovate and stay relevant? Innovation can open new growth opportunities. It can improve products. It can create new markets. Companies that fail to innovate often decline. Now examine competitive position. Growth depends on competition. If competition is intense, growth may be limited. If the company has strong advantages, it can grow more easily. Now consider scalability. Can the business grow without increasing costs too much? Scalable businesses can expand efficiently. They can increase revenue faster than expenses. This leads to higher profitability. Now look at capital requirements. How much investment is needed for growth? Some businesses require large capital. Others can grow with minimal investment. High capital requirements can limit growth. Now think about regulatory environment. Are there rules that support or restrict growth? Regulations can create opportunities or barriers. Understanding this is important. Now consider industry trends again. Are there long-term trends supporting growth? For example, digital transformation or changing consumer behavior. Companies aligned with strong trends have better growth potential. Now examine management's growth strategy. Does management have a clear plan for growth? Is the strategy realistic? Is it supported by resources? Good strategy increases chances of success. Now think about execution ability. Even the best strategy fails without execution. Does management have a track record of successful growth? Past performance provides insight. Now consider risks to growth. Every growth opportunity has risks. Market changes. Competition. Execution challenges. You must identify these risks. Do not assume growth will happen automatically. Now focus on quality of growth. Not all growth is equal. Some growth increases profitability. Some growth reduces margins. High-quality growth improves both revenue and profit. Low-quality growth may increase revenue, but reduce value. Now think about sustainability. Can growth continue over many years? Temporary growth is less valuable. Sustainable growth creates long-term wealth. Now consider timing. Is the company at an early stage of growth? Or is it already mature? Early-stage companies may grow faster. Mature companies may grow slowly but steadily. Both can be good investments depending on price and stability. Now examine reinvestment opportunities. Can the company reinvest earnings at high returns? This is critical for compounding. Companies that can reinvest effectively grow faster. Now think about external factors. Economic conditions, technological changes, consumer trends. These factors influence growth. Now combine all insights. Form a clear picture of future potential. Ask yourself, is there enough market opportunity? Does the company have advantages to capture it? Can management execute the growth plan? Are risks manageable? If the answers are positive, the company has strong growth potential. If not, you must be cautious. Now think about expectations. Sometimes the market expects very high growth. If actual growth is lower, the investment may suffer. So you must compare expectations with reality. Now consider balance between growth and stability. High growth often comes with higher risk. Stable growth offers more predictability. You must choose based on your approach. Now reflect on long-term impact. Growth increases earnings. Earnings increase value. Over time, this leads to compounding. This is the power of growth, but only if it is sustainable and well-managed. Now connect growth with previous chapters. Does growth align with business strengths? Does it match customer needs? Does management have the ability to deliver it? Alignment across all factors is important. Now think like an owner again. If you owned this business, would you feel confident about its future growth? Would you invest more money into it? This mindset helps you make better decisions. As you practice evaluating growth, you will become better at identifying opportunities. You will avoid unrealistic expectations. This skill is essential for long-term investing success. Before moving to the next chapter, reflect on these questions. What are the main drivers of growth? Is the market large and expanding? Does the company have competitive advantages? Can management execute the strategy? Is growth sustainable over time? If you can answer these clearly, you are ready to move forward. In the next chapter, you will evaluate mergers and acquisitions. Because growth is not only internal, sometimes companies grow by combining with others, and understanding this process is important for complete analysis. Chapter 11. Evaluating mergers and acquisitions. After understanding organic growth opportunities, the next step is to evaluate growth through mergers and acquisitions. This is another major way companies expand their business. Mergers and acquisitions are often called M&A. They involve one company combining with or buying another company. This process can create value, but it can also destroy value if done poorly. So, as an investor, you must analyze these decisions carefully. Start with a simple question. Why is the company making an acquisition? The reason behind the deal is very important. Some companies acquire to grow faster. Some acquire to enter new markets. Some acquire to gain new technology or capabilities. These can be good reasons. But sometimes companies acquire just to increase size or to follow trends. This can be dangerous, so always understand the purpose. Next, consider strategic fit. Does the target company fit well with the existing business? Do they operate in related areas? Do they serve similar customers? A strong fit increases chances of success. A poor fit creates integration problems. Now think about value creation. Will the acquisition improve the business? Will it increase revenue? Will it reduce costs? Will it strengthen competitive advantage? If the answer is yes, the deal may create value. If not, it may destroy value. Next, examine the price paid. Price is one of the most critical factors. Even a good business can become a bad investment if bought at a high price. Ask yourself, is the company paying a fair price? Or is it overpaying? Overpayment reduces future returns. Now consider financing of the deal. How is the acquisition funded? Is it funded through cash? Is it funded through debt? Is it funded through issuing new shares? Each method has different implications. Using cash reduces liquidity. Using debt increases risk. Issuing shares dilutes ownership. You must evaluate the impact carefully. Next, focus on integration. After the acquisition, the two businesses must work together. This is often the most difficult part. Cultural differences can create problems. Operational systems may not align. Competent management plans integration carefully. Poor integration can destroy value even if the deal looked good initially. Now consider synergy. Synergy means combined benefits, for example, cost savings or increased revenue. Companies often promise synergies, but you must be cautious. Are these benefits realistic? Or are they optimistic assumptions? Actual results often differ from expectations. Now look at past acquisition history. Has the company made successful acquisitions before? Past success increases confidence. Repeated failures indicate poor strategy. Now examine management discipline. Do managers follow a clear acquisition strategy? Do they avoid overpaying? Do they focus on value creation? Disciplined management makes better deals. Now consider size of the deal. Large acquisitions carry higher risk. They require more resources. They can disrupt existing operations. Smaller acquisitions are often easier to manage, but impact may also be smaller. Now think about timing. Is the acquisition happening at the right time? For example, during market peaks, companies may overpay. Timing affects value creation. Now consider impact on financial health. Will the acquisition increase debt significantly? Will it affect cash flow? A strong company should remain financially stable after the deal. If the deal weakens the balance sheet, risk increases. Now, focus on cultural alignment. Culture plays a major role in integration. If cultures are similar, integration is smoother. If cultures are very different, conflicts may arise. Now examine operational alignment. Do systems and processes match? Can operations be combined efficiently? Operational challenges can reduce expected benefits. Now think about long-term impact. Will the acquisition strengthen the business over time? Will it improve competitive position? Or will it create complexity and distraction? Now consider alternative uses of capital. Could the money have been used better elsewhere? For example, reinvesting in core business or returning cash to shareholders. This is opportunity cost. Now look for warning signs. Frequent acquisitions without clear results. Increasing debt levels. Declining returns after acquisitions. These indicate problems. Now consider communication by management. How do they explain the deal? Is the explanation clear and logical? Or is it vague and overly optimistic? Clear communication builds trust. Now think about risk management. Have potential risks been identified? Are there plans to handle challenges? Competent management prepares for uncertainty. Now connect acquisitions with overall strategy. Does the deal align with long-term goals? Or is it a separate decision without clear connection? Alignment is important for success. Now consider shareholder impact. Will the acquisition benefit shareholders? Will it increase value per share? Or will it dilute value? Always think from shareholder perspective. Now reflect on discipline again. Good management says no to bad deals. They wait for the right opportunity. They do not feel pressure to act. Patience is important in acquisitions. Now think about integration timeline. How long will it take to realize benefits? Short-term disruption may occur. Long-term benefits must justify the effort. Now examine post-acquisition performance. After the deal is completed, does the business improve? Do results match expectations? This is the ultimate test. Now combine all insights. Ask yourself, is the reason for acquisition clear? Is the price reasonable? Is the strategic fit strong? Can management integrate effectively? Are risks manageable? If the answers are positive, the acquisition may create value. If not, you must be cautious because acquisitions are complex and risky. Now think about overall pattern. Does the company rely heavily on acquisitions for growth? Or does it use them selectively? Balanced approach is often better. Now connect this chapter with previous ones. Does management show discipline and competence in acquisitions? Does the company maintain financial health? Does it align with growth strategy? All factors must work together. Now reflect on long-term investing perspective. Acquisitions can accelerate growth, but only if done correctly. Otherwise, they can destroy years of value. As an investor, you must evaluate them carefully. This skill helps you avoid risky companies and identify those that use acquisitions wisely. Before concluding, reflect on these questions. Why is the company making acquisitions? Are deals creating real value? Is management disciplined and careful? Are financial risks controlled? Do acquisitions strengthen long-term position? If you can answer these clearly, you have completed a deep analysis process. Final thought. Investing is not about quick decisions. It is about careful thinking and detailed analysis. Each chapter has shown a different part of the process, from generating ideas, to understanding the business, to analyzing management and growth. This checklist helps you avoid mistakes. It gives you a structured way to think. With practice, you will become more confident. You will make better decisions. And over time, you will build strong and lasting wealth. Final thought. Bringing it all together. The power of a complete investment process. You have now walked through every step of a structured investment process, from finding ideas to understanding businesses, from analyzing customers to evaluating management, from studying numbers to judging growth and acquisitions. Now, it is time to bring everything together, because real investing does not happen in separate parts. It happens as one complete thinking process. Each chapter is not independent. Each part connects with the others. A good idea must lead to a clear understanding of the business. A clear understanding must connect with customer value. Customer value must reflect in financial strength. Financial strength must align with smart capital allocation. Capital allocation must be guided by capable management. Management must have the right traits and discipline. All of this must support sustainable growth. Only when all pieces fit together, you have a strong investment. This is the true power of a checklist. It forces you to think completely. It prevents you from missing important details. It protects you from emotional decisions. Most mistakes in investing do not happen because of lack of intelligence. They happen because something important was ignored. Maybe the business was not fully understood. Maybe management was not trustworthy. Maybe growth expectations were unrealistic. A checklist reduces these mistakes. It acts like a guide. It keeps your thinking organized. Now think about how you will use this process. Do not rush. Investing is not a race. It is a long journey. Take time to analyze each idea. Go through each step carefully. If something is unclear, stop and learn more. There is no need to act quickly. Opportunities will always exist. Patience is one of your greatest advantages. Now consider discipline. Even with a checklist, you must remain disciplined. Do not skip steps. Do not ignore warning signs. If something does not fit, have the courage to say no. Saying no is as important as saying yes. In fact, successful investors say no most of the time. They wait for the right opportunity. Now think about simplicity. Keep your process simple and clear. Do not overcomplicate your analysis. Focus on what truly matters. Understanding the business. Evaluating management. Analyzing financial health. Simplicity improves clarity. Now consider continuous learning. The world is always changing. New industries emerge, new technologies develop. You must keep learning, read regularly, observe carefully, reflect on your decisions. Learning improves your judgment. Now think about mistakes. You will make mistakes. Every investor does. The key is to learn from them, understand what went wrong. Improve your process. Mistakes are valuable if they lead to better decisions in the future. Now consider emotional control. Markets can create strong emotions. Fear during downturns. Excitement during growth. Emotions can lead to poor decisions. A checklist helps you stay rational. It keeps you focused on facts. Now think about long-term perspective. Wealth is built over time, not in days or weeks. Compounding works slowly, but its impact becomes powerful over years. Stay focused on long-term results. Do not be distracted by short-term noise. Now reflect on confidence. Confidence comes from understanding. When you know why you invested, you are less likely to panic. Clear thinking leads to strong conviction. Now consider independence. Do not depend on others for decisions. Listen to different opinions, but make your own judgment. Independent thinking is a key strength. Now think about consistency. Follow your process every time. Consistency builds reliability. Over time, your results will reflect your discipline. Now consider risk. Every investment has risk. Your goal is not to eliminate risk. Your goal is to understand and manage it. A good process helps you avoid unnecessary risk. Now think about balance. Balance between growth and safety. Balance between opportunity and risk. Balanced decisions lead to stable results. Now reflect on your role as an investor. You are not just buying stocks, you are becoming a part owner of businesses. Think like an owner. Understand what you own. Trust the people running it. This mindset changes everything. Now imagine applying this process repeatedly. Each time you analyze a business, you become better. Your thinking becomes sharper. Your judgment becomes stronger. This improvement compounds over time, just like your investments. Now take a moment to summarize everything. A strong investment requires a clear idea, a deep understanding of the business, a strong connection with customers, a durable competitive advantage, healthy financial performance, wise capital allocation, trustworthy and competent management, sustainable growth opportunities, careful evaluation of acquisitions. When all these elements align, you have a powerful opportunity. Now, remember one final principle. You do not need many great investments. A few strong decisions can create significant wealth. This is why patience and selectivity are important. Focus on quality, not quantity. Now think about your future as an investor. If you follow this process, if you remain disciplined, if you keep learning, you will improve steadily, and over time, you will achieve your financial goals. Because investing success is not about luck, it is about process. It is about thinking clearly. It is about making better decisions again and again. This is the true message of this book. Use this checklist as your guide. Trust the process. Stay patient, and let time work in your favor. If you found these insights valuable and want to go deeper into real investing wisdom, then it is time to read the complete book. The Investment Checklist offers a powerful step-by-step framework that can transform the way you think about investing. Instead of guessing or following the crowd, you will learn how to analyze businesses with clarity and confidence. Every chapter builds your thinking and helps you avoid costly mistakes. If you are serious about long-term wealth and better decisions, this book is worth your time. Click the link in the description and get your copy today. Start building a smarter investment mindset now.